Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go over Twitter, look at some commodity information. I do this. I also interject my financial opinion in the mix of it, so you guys get a little bit different viewpoint than just what's being read. I usually add in my background. It's engineering. I've been reading finance type stuff since I was my early 20s. It's almost 20 years now, and I think a lot of people like me kind of step in here to give my opinion on information that we're seeing on Twitter. So if you want to follow me on Twitter, it is at finding_finance. That's my name. You can add me there. I retweet a lot of this stuff. That's where I'm reading it from. I also post a lot of my own content and information on Twitter as well. So let's go through it together. It says Doomberg. And just to let you know, Doomberg, I'm going to be recording a video with Doomberg. It's scheduled for Friday, 8/26. I'll release it sometime after that, obviously. So this is one. It says, Venezuela halts oil shipments to Europe, saying it is no longer interested in oil for debt deals and instead wants refined whatever it is. So they're not doing oil for debt. That's bonds or dollars or fiat currency. I think the world is going to start rejecting fiat currencies and bonds very soon here. This is, I think, a paradigm shift where Russia, I think what happened is in 2020, we had the medical event, and we printed a bunch of money, stimulus. Putin has said on camera, you can research this if you like, that he doesn't want to accept fiat currency for oil anymore. And I'm seeing this here with Venezuela. I think what's going on is the oil-producing countries are starting to figure out that oil is going to be ultra valuable here. And they don't want to trade their oil for worthless pieces of paper. And if we are turning the corner where world oil production is starting to peak, you could see currencies start to fail because we have a debt-based system that must grow, must continue to grow. And if you can't grow your energy, you won't have the other end of it, the GDP growing. It'll get stuck if your energy cannot grow. Again, that is speculation on peak oil. It's speculation on peak energy from fossil fuels. But if that were to happen, we could see currency problems out in the markets, and we're starting to see the beginning of countries not accept commodities for worthless pieces of paper. Here's one that says, very soon, carbon credits will become a legendary short. Every macro fund should be fixated on this. They are a tax on humanity that will be expunged. They are going to zero. Even better, you can feel socially responsible about shorting blatant fraud, which makes this one fun. Carbon credits is something that is disgusting. I don't play the carbon credit market at all. And I agree with this statement. They're basically taxing humanity. Energy is life. Life is energy. And if you tax that energy, you are taxing your life to some extent. It says, while energy is more needed than ever in the EU, the carbon credits are priced higher and higher. The ESG mania and oil forward curve barely at break even does not sustain an increase in capex for the oil and gas industry. Even more fuel to the energy squeeze. And they're dumping all this stupid stuff on, guys, and it could get pretty ugly here. And what I mean by ugly, like just the overall cost of energy is going to get ridiculous with ESG, with carbon credits, with the lack of investment in fossil fuels. This transition is going absolutely horrible. And Russia not willing to accept fiat for their oil and eventually breaking the link of oil to the dollar, I think is the beginning of maybe the end. The beginning of the end of certain currencies. That could be the dollar even. And that another thing that as we see this, we could see interest rates diverge from what the market would normally do because the dollar is coming under threat. and they need to protect the dollar at all costs. And they may have to raise interest rates to astronomical levels. Yes, it's going to cause a recession. Yes, it's going to crash other assets, but it could be, currency war related. It says, I'm feeling quite good about my $100 calls. Glad I went out to 2025. And what this is, it says Biden is selling SPR reserves to win midterms votes. Has to be in the top 10 dumbest policy errors of all time. Enjoy paying $10 at the pump by Christmas. Hope you have some, well, he's talking about this stock, but this is the U.S. commercial crude stocks. This is as reported. And what he's doing is he's taking money from the SPR and just moving it over. It's basically just accounting fraud, so to speak. They're moving it from the SPR over into the other inventory, and they're saying, hey, look at this. But if you were to take that SPR out, this is what the deficits look like. This here is a massive problem. This here, if it gets out of control, can bring down economies, can bring down currencies, can bring down a lot of different things. Now, is it going to go to that extent? I don't know. But I can tell you this, I've got some more information coming up where oil is going to be coming off the market. A recession will have to happen because the demand will have to be destroyed somehow in this world. Demand for natural gas needs to be destroyed. Demand for coal needs to be destroyed. Demand for oil needs to be destroyed. And I think the only way that demand can be destroyed because the supply isn't there is through a recession. Scrolling down, America, take 50% off your entire net worth, Banana Republic. It's coming, guys. I've got a lot of cuppy stuff here. Yeah, I've got this one. He's fighting between recession and inflation, and he can't go anywhere. Now, this is what I was talking about with the barrels of oil. It says, loss of 3 million barrels per day of oil and 2 million barrels per day of oil refined products expected due to announced sanctions on Russia, former Saudi Aramco senior exec. Unlikely, but if so, oil prices would go much higher soon. He says over 3 million barrels of oil will be lost by November. By November. This is going to get real interesting real fast if this is true. When those strategic petroleum reserves, when they stop, and remember, those sanctions on Russia, Russia's oil production is high because of Western technology in drilling. That is all moving out of the country. You're going to see supply go down in Russia because of Western companies leaving. So this is going to get real interesting very quickly on the energy front. I think we're going to see inflation in terms of consumer price index go much, much, much higher. This could diverge the interest rates from everything. And we could see housing eat it for a little period of time, depending on how much money they're going to have to print. Remember, if interest rates go higher and if the market forces that, they're going to have to print money to hold those interest rates down. And if they don't hold the interest rates down, they're going to have to print money to cover the interest payments on that debt. This could be exactly what Russia's trying to do with the Western world and all the debt that we're in. They could be trying to break our currency. Coming on down, it says, once it starts, all the tax revenue will go towards interest expense. It is checkmate then. Welcome to Project Zimbabwe. And that's what I'm talking about with some of this energy too. If energy were to go up, it's going to force those interest rates higher. And then your interest expense is going to be, well, greater than your tax revenues. It says, Ronnie, this is real estate. Prices in Turkey going bananas. Remember, Turkey is going through hyperinflation. Probably no coincidence that housing is also known as concrete gold. And this is rocketing higher. We're starting to see that in our markets as well. And I think it is not just policy driven, but also, debt driven, policy driven, and an energy crisis driven. You're going to see these things go ballistic, I think, around the world. The people the people who are controlling this are the ones that have all the assets or all the oil in all the commodities. And America is very commodity rich, don't get me wrong. It says, bro, you're upsetting all the housing bears. Stick to the narrative. Rates plus rate equals something bad. But this is the total housing inventory data is getting better. Almost back to 2019 levels, which was the 4-decade low before 2020. What he's basically saying is that the inventory of homes is still incredibly low. I know that the new housing starts have fallen and that the new home prices the average of the new home prices have come down a bit. But the inventory is still at incredibly low levels. We do have a housing shortage because, by definition, if you don't have inventory of homes, you have a shortage. I know some people have responded, oh, there's no shortage. There is a shortage. That's why the inventory is so short. By definition, if the inventory is short, you're short homes. That's by definition. So there is a shortage of homes. It is very low. Now, will this continue to go higher, the inventory? That's what we'll have to see. We'll have to see seasonality. We'll have to see what interest rates do. We'll have to see what the market does. Looking at ESG, $60 billion for diversity as we fight the climate crisis. Diversity? Wait, what? ESG diversity? I don't know, that's what she said in her clip. 40% of homes in the United States owned outright. Long-term value of entire home stock in U.S. is 30, or loan to value of entire home stock in U.S. is 33%. We're not having another housing crisis. So that's some more data there. So this is where we are at in the 1970s and today as a result of, we saw an energy crisis in. These huge energy price rises caused double-digit inflation, with the prices of everyday goods such as clothes, food, cars, and houses going up by 300% to 500% in 10 years, even more in some cases. There were large-scale protests, riots, and civil unrest. Entire sections of the economy ceased to function, and unemployment reached all-time highs. The winter of discontent brought misery to huge swaths of society. In the 1970s, but not today, double-digit inflation was almost immediately matched by double-digit interest rates, which peaked at 17.9% here in the UK. A collapse in demand slowly over several years helped cool inflation. With an economy laid to waste and a lost generation of entire communities ceased to exist. It has been a close call, but hyperinflation was avoided. We no longer have the ability to raise interest rates to 10, 15% or more. Can this system be saved this time around? And he's talking about inflation and the inability to stop it. I agree with him. It's becoming more apparent as the energy crisis deepens, and we're starting to see their inability to raise rates. And I think we could have basically uncontrolled inflation. We'll see. We'll see what happens. Again, this is all kind of just adding up. What I've got here, this is one of my posts. Commodities still outperform the S&P 500 and a short-term break higher. Could the pullback against stocks be done in the short term? And this is the CRB to S&P 500. Wave 1, Wave 2, and Wave 3 is what I think is coming. We've had a short-term pullback. Now that pullback is lurching higher out of its descending wedge, where commodities are starting to outperform the stocks, the S&P 500. But we've moved higher. I know the S&P 500 has gone lower. The CRB index has gone a little bit higher, and that's what this resultant is. Is this a start of a next leg higher? I don't necessarily know. I think it is, but it sure looks like it is to me. I don't want to say yes 100% sure that it is. There's always something that could happen in the markets that could reverse this, but to me it looks pretty promising that the commodities could outperform the S&P 500 here going forward. What I put here is the natural gas. Natural gas continues to move higher in the USA. I've got the Livermore accumulation cylinder. Check out the TTF and UK natural gas prices. And then eventually what I think is going to happen is a converging of prices at some point in the future. And this is natural gas here. This is the Livermore speculative chart. 1, 2, 3, 4, 5, 6, 7. And then we get this large break. We've got 1, 2, 3, 4, 5. Is this number, it's 1, 2, 3, 4, 5, 6, 7 is here. Is this the bottom here, or are we going to go one last time down? I don't necessarily know that, but this sure looks strong, like it wants to break out and go to maybe number 8 or 9. Now, what's happening here, this is the Henry Hub natural gas futures prices. This is in America. We've been moving higher here. This is what it's chasing with the Freeport liquefied natural gas terminal on back online. It's going to connect this market with this market. This is Dutch TTF natural gas. It is going higher. Look at the size of these candlesticks here, guys. This is massive. This is also UK natural gas. It is moving higher like no other as well. This is getting to levels 30, 40 million, $30 or $40 per MMBTU. We are at $9.30. This, I think, will move higher and converge. I don't know the exact pricing, but I think that we are going to see a convergence where this price moves higher. These will tampen down, slow down, or possibly go lower. But I don't know if that's going to happen before winter. This is going crazy. And they are finishing quite strong here. These are strong candlesticks. This is a large squeeze going on here. It's a big squeeze. So that's natural gas. And I've got a lot of really good investments for natural gas on the website. Again, I've got a question and answer session, 5 p.m. Mountain Standard Time on Sunday, which is today. That I'm going to go over some of this information with the group. If you guys want to ask me about natural gas, I'll share all the companies. If you've been on the website, we've been loading up on them already. You know which ones I like. So if you want to join, find out what those natural gas companies are to play this movement, sign up to the website in the description link below. Platinum membership will get you all of that information. So coming on down, this is the stock market. The 10-year yield continues to move higher. So that's moving higher. This yield is moving on up, and we're getting these large, big candlesticks in here. Someone's dumping it, dumping our bonds. Now, the yield hasn't gone up into critical levels yet, but it could. And if you were to look at this chart and you were to overlay this chart with some of the oil stocks, this is basically the same chart as the oil stocks. I don't think they have a chance of keeping this down, guys. I think we're going a lot higher with oil prices. We have a crisis on our hands. It's energy driven. I've shown you the supply-demand imbalances out in the future in oil. I've shown you what's going on with natural gas. Coal is rocketing higher. Uranium's going to join this mix. It's just late to the party, guys. It's still doing the pre-party mixing drinks or whatever it's doing over there. It'll come. It'll show up. It'll be late to the party, but man, it's going to make one heck of a noise when it comes when uranium comes coming in. It's going to be a big move, I think. This is Europe is lurching into an energy crisis. We all know this if you've been a part of the channel. German and French electricity prices keep climbing. And look at the electricity prices, guys. This is ridiculous. Absolutely ridiculous. Now, if you were to combine oil, natural gas, the electricity prices, all of these things together, we are going to have to eat it. There's going to be a huge recession in Europe. You can't get around this. This is going to close down businesses. This is going to be a big problem. Now, I know a lot of people say, I'm right because interest rates are the interest rates are not the driving factors, guys. They aren't in charge of this anymore. The governments and Federal Reserve banks, Russia shutting down the energy to these areas, they're in charge at this moment. And we are seeing ridiculous price moves, and it will harm the economies. It has to. You can't have electricity prices going vertical like this for this long. It's going to have a big impact, I think. This is Eric Nuttall. Sometimes it's easy to lose perspective, but every day above $90 West Texas Intermediate is a great day. And these are the companies on here for 2023 enterprise value to cash flow. This is 2023 free cash flow yield to equity. And the companies in the upper left are the ones that I usually invest heavily in. I've got my favorites. Again, if you want to know my favorites, become a platinum member in the website and I can go over that with you. This is also energy stocks trading at an estimated 20, 25, 29% free cash flow yields. And there's the whole gamut there. I talk about the great reconfiguration of the economy. What I mean by that is more people are going to have to work in energy-related sectors coming up here than they did previously. And I think there's going to be a gigantic paradigm shift in the economy where things are going to go bankrupt because of these electricity prices, natural gas prices. Companies are not going to survive if their input costs go up as much as these input costs are going up. Then we're going to have to put more jobs, more, we'll call it thinking power towards solving our energy problems. I think that the next decade or two, the most amount of money will be made in energy. And the biggest problems and most lucrative areas will be energy driven. And I do think that we're going to go in a nuclear renaissance. I really do. This is an energy crisis deepens Germany. Their power prices in Germany going vertical. This is not sustainable, guys. Like, this is going to break stuff. It's going to break stuff all over the place. This is ridiculous how high this is getting. It says, if the world is now dependent on U.S. exports of crude, we are entering into the biggest oil and gas boom in history. They cannot destroy demand enough or cause a recession that solves this. Drill, baby, drill. There's also a bunch of opportunity, not just in oil and natural gas, but the energy service companies. I do think that it's going to be drill, baby, drill. And some of these energy service companies are still incredibly low. The name of the game is, be right, sit tight, and just sit. Get in the companies when they're cheap and just sit on them. There are some really big setups in energy service companies that are pretty ridiculous here. The price of oil could quickly rebound. And this is from the FOMC minutes. Declines in the prices of oil and some other commodities could not be relied on as providing a basis for sustained lower inflation, as these prices could quickly rebound. They even know that this is possible, guys. They're holding it down, and they're not going to be able to hold it down forever. They know that this could quickly rebound in terms of oil and cause a lot of problems for them. They know that, and it's out of their control. They are poo-pooing themselves right now, I think. It says currently showing 7.7% for the headline CPI for August, down from 8.5% in July. Remember, energy is a big mix in this as well. They're trying to push that price down to get this down, but it's only going to be temporary, I think. Gasoline prices accounted for 131% of this decline, with other categories partially offsetting. This will go back up. I'm sorry. Gasoline prices are going to go back up, I think. We had a large oil draw this week in the inventory report. We had 7.1 million barrel crude draw. We took 3.4 million of strategic petroleum reserve. Domestic production was 12 million barrels. We had a big draw on gasoline, 4.6 million. Guys, this isn't solved. It's getting worse. Now, it's going to, from week to week, it's going to fluctuate up and down, but it's still very bad. This is not improving. If you can overlay those two things that I told earlier about the strategic petroleum reserve ending, and then the less barrels being sent out of Russia, and if China comes back online more so, with their shutdowns and whatnot, we're going to see a very tight oil market. We could see much higher prices. I don't know how high. I'm not trying to predict the ultimate top here. I just think it's going to get super tight. We've got platinum continues to disappear as 2.1% of the COMEX inventories. 5.3 thousand ounces leave the vaults today. 243,000 ounces left. And I know that we've seen very big volatility in the precious metals. You know what? I don't really care. I'm going to keep adding in. Don't matter to me. I'll keep buying it. Coal is Jeffrey's favorite commodity for the next 6 months. He's got BTU as one of the companies. Met coal is heating up. Thermal should remain hot. That's because of the energy crisis, especially for this winter in Europe. They're going to burn anything they can. And then I've talked about housing starts in another clip. Tracking global oil inventories remains my best compass to navigate through times when the financial versus physical demand for oil collapses. Maybe some chop to get through the next month or two, but still very positive in Q4 and beyond. We remain bullish, and I remain bullish too in oil, natural gas, and all energy-related commodities, including uranium, guys, including uranium. Here's one. This is the glorious commodities bull market will be the greatest opportunity in your lifetime to get out of the rat race. As said in 2.5 years, do not miss it. This is URA, which is uranium, versus the S&P 500. And this is just doing one large bowl-shaped type movement. This is 15 times up to all-time high from where we are currently sitting. Right now, we are still making our way, scraping along the bottom, so to speak, before we move higher. We could see this get pushed and pulled in all sorts of ways with the overall stock markets. Sometimes they're correlated, sometimes they are not. This is going to have to break apart, and when we see a massive shortfall in uranium, physical uranium, I think the miners are going to do ballistic things. I really do. Here's UK inflation hits 10.1%. There's an elephant in the room. A four-part clue: debt levels, interest rate, stock market, economic collapse. I agree with that. And here we are moving higher. This is the price producer index is currently 17.1%, with inflation at 10.1%. When we get to those levels in late 1973, green circle, UK interest rates were running at 9% to try to tame that inflation. Today, they're 1.75%. Let that sink in terms of how the real negative rate is here. And this energy crisis is going to blow this thing out of the water. It's going to get pretty nasty, I think. Here's the average new oil and gas developments in offshore Europe are now 10%. The volume versus 1960s, 70s when petroleum was initially discovered in this area. The world's easy oil has been discovered, produced, consumed, and in terminal decline. Geology 101, invest accordingly. Basically, he's pretty much saying that cheap oil has already peaked. The elephant in the room, this is another one. What this one is UK government bonds 10-year yield. We are way down here. They're starting to come up, and perhaps this is going to go way higher over the time. And that's yields. Now here's the big four storage: crude with SPR, plus gasoline, plus distillate, plus jet fuel, and it is declining. I don't know how oil prices are declining with this decline here. You would think they would be slowly increasing. Mostly on hot weather and anticipated of the Freeport LNG plant reopening. Crazy European prices are pulling up US ones with them due to arbitrage via LNG. Next up is Europe burning oil instead of gas, and how this pulls up crude prices. And this is natural gas pulling up the Henry Hub price, our futures prices here in America. But that's what we've got for today, guys. I'll end it there. There's a lot of information to chew on, but that's what we've got for the information that I've shared on mine. I'm a huge oil and natural gas bull, huge uranium bull, huge energy service bull. Anything that's that related, I am a bull in it. I also like physical metals because I think that eventually we could see a currency crisis in a lot of these different countries. What happens is, and I'll put a video out on Twitter as well. It's about Colin Campbell, an oil geologist, talking about the debt markets and oil. And I agree with his statement, which is basically, to sum it up, easy or cheap energy is what backs these economies and the debt of those economies. If you don't have easy oil, and if the oil volumes were to decline, the debt cannot decline. It must continue to go up by the design of the system. The system is predicated off of future cheap energy. And if people perceive that that future cheap energy is not there, you're going to see markets start to collapse. Currencies and bond markets start to collapse. That is if we're at peak oil. I don't know if that's the case, but it could be. I don't know. Maybe this is the something that pricks that bubble, or pricks that to get it moving would be a war. Russia basically not selling its oil for fiat currencies. Maybe that's what starts it all. I don't necessarily know. I'm just letting you know that if it is peak oil, we could start to see stresses in the system, in the bond market and currency markets. But that's what I've got for today. Thumb up for the content. Subscribe to the channel. Subscribe to the website if you're interested on how to play this. The description link's below, and you can see the investments that I have in my portfolio as I'm sharing my portfolio on the website. All right, guys, we'll catch you later. This is Finding Value.